Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. This is Gary Wilson, your host. I'm glad to have you back. Hey, if you haven't already done so, if you could, please go ahead and subscribe to the podcast. That's on all the different channels, Apple, iTunes, iHeartRadio, you name it. And while you're out there, click on the brand new website, globalinvestoragent.com. We just created it to showcase agents who are not typical agents, or not your traditional Sunday open house agents. These are investor agents. They're certified, which really doesn't mean much other than the fact that we train them. Remember, we're investors. We train them how to identify, analyze, and negotiate on and off market deals. And we actually give them the tools to do it. So you and I are handing off a lot of our heavy lifting on the front end of this whole business we're in. So take advantage of it. Go out there. It doesn't cost you a dime. Grab one of those guys. And if you are an agent, boy, you'd be crazy if you didn't look into this right now, because the market is getting ready to change. And if you were around in the last recession, you know what happened. Half the agents disappeared overnight. Don't be a statistic. Be successful and figure this whole thing out. So click on that button and get yourself a conversation. Meet some of these guys and position yourself for what's coming on the road. So speaking of what's coming on the road, we got a great guest today, Casey Brown. Casey Brown's from beautiful Kentucky via Colorado, and does something I don't do, which is capital raise, as well as some other things. So first off, Casey, thanks, man, for being here. We certainly appreciate you giving us your wisdom and your time.
Well, absolutely, Gary. Thanks for having me. It's always a pleasure to talk and meet new folks and see how everybody's kind of figuring their own path. You got
it. So I'm just curious. I've spent a lot of time on the road teaching for several years. I've been to many places in Colorado and many places in Kentucky. But what was what brought you from Colorado to Kentucky, and is that where you got your first deal? So maybe a little bit of background there.
Let me give you a little bit of background. So I was actually born here in Kentucky, a little town called Hopkinsville. We're right near Fort Campbell Army base, and my parents moved to Colorado when I was 2. My grandmother was still here, and some other family was still here. So I came back to Kentucky after I graduated high school. And so with that being said, my first deal, really, yes, because I was going to college here and I was learning some new things and trying to get into real estate. And so, sorry about the notification. I was trying to figure out a way to make sure I got that turned off.
Okay.
Are you there?
Yep.
Okay. Can you edit that out?
Yes.
Okay. Just edit that spot out. We'll start back. So, all right. So when I turned 18, graduated high school, I moved back to Kentucky to live with my grandmother. She was still alive at the time, and she was, of course, getting up in age and moved back to the family farm, I guess. I attended Murray State University and got a degree in agricultural economics, ag business, and had taken some real estate courses over there. Graduated college and came back to live again near my grandmother. And just one day I just finally was like, I was driving down the road and I had some issues with the employer that I was at. And I was driving down the road and I saw, without name dropping, it was a Caldwell Banker sign. I saw it on the road and I said, I think I could sell real estate. That would be fun. That would be, I had the whole Better Homes or like the whatever TV show in my mind. I was like, they make it fun, so why can't it be fun? That'd be great. And so I started. So I went and got my sales associate license and started selling. Started getting listings and selling to buyers that would show up one way or the other. And as I moved through the process of learning how to do that, I got my broker's license, and I had built a very what I call a transactional business. Okay. So when I say a transactional business, and at one time I thought I had actually coined that term, but it was something, turns out it was something that somebody else had the great idea to talk about a transactional business. And so what I mean by that is my whole livelihood was based off of the next deal. Okay. The next deal, the next deal, the next deal. If that next deal didn't come, I didn't have income. And so I began buying rental properties at that time. And this is about, this is post 07, 08. So this is like 2009, 2010. Started buying some rental properties and was beginning to really get some leverage and really gain some steam on my abilities to be able to move on things fairly quickly. And as we all know, the quicker you can move, the better deal you get. I was really digging in. And then one of those life events, basically, those life events that smack you in the mouth and say, hey, you're really not as big and bad as you thought you were. That life event was a divorce. Okay.
Oh, yeah.
Now, the divorce, without getting into gritty details about everything that went on, was a pretty harrowing experience. And so I remember I told all of the attorneys involved. I told everybody sitting at a table during a mediation. I said, listen, sell it all. I don't care about any of it. I don't want a dime. Sell it all. Sell every bit of it. So the next week we put everything up for auction. I had acquired 30 something units. It was about 30 something doors. And this transactional business that I had built, I said, okay, hey, we're going to keep on rolling with that. And I'm going to get rid of the rental properties because that was what was the bottleneck, right? Well, when my life changed for the worse during that part was when the gavel dropped on those rental houses. And the reason that it changed was because all of a sudden my cash flow was, I was starved for that cash flow that those rentals were providing. Okay. Even though my sales business was still reasonable, still picking up $4, $5, $6, $8, $10,000 a month as things moved on in commissions, right? Well, it didn't take long to realize that if I was going to get out of the situation that I was in with no income, with no regenerating income, I was going to have to do something. Something was going to have to change. Now we're talking like 2015, 16, 17, right? So as I'm licking my wounds of financial crisis and trying to figure out my path, my way, and trying to figure out how to use this transactional business to get back on my feet, right? So the transactional business, of course, naturally shrunk a little bit because of there was some custody issues that I was still battling even after everything. So again, my attention was sparse as far as that goes. So with all that being said, I realized, hey, you've got to get that cash flow back. If you don't get that cash flow back, this is never going to change. It's never going to change. You can make $100,000 on one sale. You can make $100,000 on one sale per month. And if that lumpy income, that 13th or 14th or 15th month, when that income doesn't come, that's when crisis hits. I don't care how much you make. If it's lumpy and it's not steady, it's not flow, it's not good. And that's a fact. And I don't care. I mean, that's just the way it is. And so I was able to land a few decent sales for the lumpy income side of it. And what I did was I took a portion of those and began buying rental houses again. Okay. So I bought my first one, and believe it or not, it was a $30-something thousand house, right? The bank required me to put down $6,000 or something like that. So I put the $6,000 down, right? Got the house, got it closed. Now that house was renting for $525 a month. Okay. So now, as you can tell, I'm starting to build back into what I had determined was the most important part of my business plan before, although now I had physical proof that it was absolutely the most important part, which was the cash flow. And so now with that purchase, now we've started accumulating and started buying and starting to get back on my feet, 2017, 18, 19. And then one day I saw a guru online, and I'm not going to name names but everybody in this space knows who I'm talking about. And I kept saying, how is this guy buying? Like, what is he doing? Because one of the things that I heard during my life events was there's more billionaires and millionaires made in the real estate business than virtually any other business there is. And that struck me. It struck me. And I was like, it was almost like, again, a smack in the mouth. I was like, what? I was like, here, and you're talking to somebody that commission wise had at times netted $200,000-$400,000 a year. And I'm staring back, and I'm like, and again, that money was spent living a life, livelihood, whatever. And so then I'm like, really? Millionaires and billionaires? I'm like, don't get me wrong, making $300,000 in a year is great. It's awesome. But that's not millionaire, billionaire kind of stuff. I mean, it is obviously if you're able to put most of it back and leverage it and build and go. But I'm like, these guys are buying like $20 million apartment complexes and $30 million deals and $100 million deals. And I'm like, how does this work? What am I missing here? I dug in right then. I stopped for the biggest part of what I could. And I said, all right, we're going to focus. What is going on here? And then all of a sudden it hit me. I was like, wait a minute. These guys are using other people's money. Now, how does that work? And again, I dug in. And as I dug in and started uncovering the way all of this works, it opened my eyes. And I'll tell you, one of the first people that I just, when it hit me, I just stood there and I just shook my head back and forth for an hour. And I said, Warren Buffett, Berkshire raises money through selling their own stock. Then he does nothing but turn around and buy other stocks.
Yep.
I mean, I'm just like, what in the world?
Yeah.
And so, and it hit me, and I said, that's it. And the way he does it is he raises enough capital on the stock side that he's able to go in and get a massive position within these companies and get on their board and then he has, and so although that is a different niche of investing, we're talking about stocks and shares of certain soda companies and insurance companies and whatever. But I said, that's what they're doing in real estate. That's what they're doing. They're going to investors and they're saying, hey, here is an LLC that's going to own 123 Main Street. And I'm going to sell you an undivided slice of this LLC that owns that. And the investors are going, okay, well, that's great, but what's my return? And then it's so simple. It's so easy. And it just, again, the capital raising side was something that I had to dig in, because I couldn't, when I first started looking through the lens of saying, okay, how are these guys doing this? And when the capital raising part really hit me, I thought, okay, so you have one of two choices. To me, you're either an operator, deal finder, whatever you want to call it, or you're a capital raiser, which is in my opinion, a different term for an investor relations specialist of some kind. Somebody that can cater to the people that are investing with them. So anyway, I know that's long-winded and probably a longer answer than you ever dreamed possible.
That's
but
okay. It's good. Good stuff.
that is where capital raising really came from. I've naturally always been able to kind of find deals, if you will. Again, most of that has been reflected in my local market. So the idea of going outside of my local market is a little bit harrowing, as far as like, just simply because at times you don't want to be sold to. You want people to be like, hey, they're getting ready to build a sewer plant right there. If you buy this for this price, the sewer plant is going right there. And so at times you don't want to be sold to. You don't want to be told all the good things about something and not the bad. So that's what was such a holdback about leaving my home market and starting to look at some of these bigger assets was, okay, you have to make sure that your underwriting models are correct. You have to make sure that you have people, boots on the ground, that you can trust, because at the end of the day, investors have trusted me with their money, and the boots on the ground that I'm trusting to tell me, hey, this is a reasonable deal. This is a decent deal. This is not a good deal, whatever the case is. And you have to understand that you're going to underwrite probably 50 properties for every acquisition, right?
Yeah.
And so it may be even more than that. Just you're going to underwrite as many as it takes to get to the good deal, or underwrite them, submit an LOI based on what works for you. And you just never know at that point. So with that being said, that's where I really started kind of looking into this game, but just looking into this capital raising space and the acquisition. And again, it's the same thing that real estate investment trusts do. They are a little bit more that they're of course bound. They're bound a little differently, and of course they're run through, the IPO process and so on and so forth. Whereas, a syndication is simply done through, the SEC has regulation, but it's considerably less encumbering to do that than it is like a real estate investment trust. And that just basically what it does at the end of the day is saves the investors money. It saves the investors from having to how much of a REIT's profit goes towards expenses that they actually do versus having just income. You have a manager that takes a little bit, you get a property manager, and then you get the rest. REITs have all of that plus the expenses of big guys, I guess, if you will.
Oh yeah. Yeah.
So anyway, that's where we're at. So
we'll be right back with the Massive Passive Cash Flow podcast after I invite you to Monday Night Live. Every Monday night, 7 p.m. Eastern, I teach a class without fail for you on subjects ranging from flipping to buying rentals, managing rentals, wholesaling, commercial, creative purchasing techniques, analyzing properties, identifying properties, hundreds and hundreds and hundreds of subjects. And if you are a licensee, if you have a real estate license, you should definitely tap in, because there are a lot of investor agents also in the class. Many of them are on the global investor agent team. So you can learn from them as well as from me how to actually work with investors correctly and profitably. All right, we'll see you Monday night. The link is in the show notes. Go ahead and register. We'll get right to the Massive Passive Cash Flow podcast. Well, let's talk about the capital raises. I've actually did create years ago, essentially was a REIT. It was a closed-end mutual fund. We had a tobacco commodities broker from Wall Street and an attorney that structured. Wall Street guys were leaving Wall Street. That's how bad it was. They were coming to real estate, and I just happened to have the right model at the right time, and that was my second big connection in life that made me rich and famous was this guy. We started buying up portfolios of properties and selling off chunks of them, and I was getting all the commissions, and I got the management contracts and part ownership and stuff like that. It was amazing. Yep. But you're right, it was a lot of moving parts, and there was a lot of overhead. So what you're doing with the capital raises, I know one question people are going to, if it was a live show I was interviewing, we'd get a lot of hand raises. Well, Well, how do you find these guys with the money? Is there a, like, do you vet them? Do you, all that whole piece, it baffles a lot of people,
So just for context, there's a 506B, which so SEC Regulation D, okay?
Mm-hmm.
There underneath Regulation D is what's called a 506B.
Mm-hmm.
And there's also a 506C, but let's talk about 506B first. 506B a lot of times is referred to as the friends and family capital raises, and that's basically what it says is it can't be advertised. You can't advertise it on a mass scale like Facebook ads or Google, right, or click to invest and stuff like that. It can't be advertised on that level. So it has to be based off of people you've had a prior relationship with. And again, and I'm sure you know this, I guess I'm more or less giving some context for the listener so we can talk about where different segments come from. Now, 506B is not my cup of tea. Okay. For one, the main reason is because I enjoy going to Thanksgiving dinner without being asked questions about how my money's doing and what my money's doing, where my money is at, whatever the case is. I just enjoy my family. And I've always been a big proponent in saying the fact that when money and family and friends gets together, it's a lot of times, right, the situations that can be created are just awkward and they can be very divisive. So anyway, that being said, 506B, the friends and family, you go to your friends and family and you say, hey, do you want to invest in this deal I found? I need a minimum 50 grand, whatever. Okay. 506C is very similar, but the 506C you can advertise. You can advertise anywhere and everywhere, wherever you want to put it. You can buy billboards, you can buy as many ads online, you do whatever you want to do, right? But the investors have to be, okay, so 506B, those investors have to be sophisticated, and the SEC gives guidelines as to what a sophisticated investor is, right? So 506C, again, you can advertise it everywhere, anywhere you want to go, but those investors have to be accredited. There's a list of, again, the SEC gives guidance and gives a list of things that say, hey, this is what an accredited investor is made up of. And there's, of course, third-party companies out there you can use to verify if you can't get a letter from their attorney or their accountant that says, hey, he's an accredited investor, she's an accredited investor. You use a third-party company to verify it and go from there. So that being said, obviously the 506B, you can see how how you would raise that capital. You go to people people you've had a prior relationship with, and say, hey, do you want in on this deal? Right now, both of these, I want to start the idea that both of these, a lot of people don't realize that you can use your 401k or your IRA towards the purchase of shares of one of these syndications, right? Mm-hmm. In a self-directed IRA, a self-directed 401k, that kind of stuff. So that makes the friends and family stuff a little bit easier, maybe, because if you go to somebody and they've got 300,000 or 400,000 or whatever in their retirement account, they can have that changed, or it might very well might be currently a self-directed IRA, and they could say, hey, I don't want to own $50,000 worth of whatever right now. I would rather take that and put it into this deal that Casey's got over here. And that's perfectly lawful. Of course, you have to have some guidance and some help through that process. But the reason I bring that up is there's capital out there. There's people out there that have capital that may not realize they have the capital, right? Mm-hmm. So the same thing is to be said with the accredited investors. There's many accredited investors out there that have $1 million in a retirement account, and believe it or not, these more sophisticated folks don't realize that stuff can be put into single individual real estate deals. Mm-hmm. And it's boggling to me that the people that have, I was talking to a real estate broker, and I say boggling because I was on the same level. But I was talking to a real estate broker the other day, been in the business like 30 years. Mm-hmm. And I said, we're moving towards, he called me wanting to recruit me to his firm on the sales side. And I said, listen, man, I'm moving toward the syndication world. I don't know that I'm going to be your guy, but we'll think about it and whatever. And he said, syndication, what is that?
Mhm.
And I mean, and this is a big time broker. Like he's in Nashville and he's over like 300 or 400 agents. And he's like, what is that? And I'm like, really? What is that? And explaining it to him. And it was just like, he was just like, huh, okay. And I was like, yeah, exactly. That's the way I was. So to go back to the 506C where there's accredited investors. Now, this is a little bit tougher. Again, you can advertise it anywhere, but it's a little bit tougher because you're dealing with a little bit more of an affluent individual.
Yeah.
And the affluency of these individuals, they don't get hung up a lot in the weeds. They don't get down and want to know like whether, they're saying, okay, here's my money.
Yeah.
How much return can you give me? How secure is it? And what are you going to do to make sure I get my money back? So there's pros and cons to it, right? So basically we started with some social media ads to put out there and at least test and see what was available, what people were doing, what people were looking at. Now, without getting too far into, and I'm not going to explain exactly how this is all set up structure wise and so on and so forth, because that can be very confusing. But the big thing right now is people are setting up real estate syndication funds, and that's what we set up. Okay. Now I'm going to explain how that works very briefly, if that's okay. Is that okay?
Sure. Yep.
All right. So we are what's called a fund of funds. The fund of funds model is set up like this. So the first question is, now I'm going to explain, this is how it is. I take investors' money, right? Then I go to, let's say I call you, Gary, and you've got a deal and you're like, hey, I'm setting up the syndication and, I'm taking investors' money. Okay. So then I say, okay, I take investors' money, then I buy into your deal with it, right? Now, creates a huge question. Well, why wouldn't I just go to Gary and buy into his deal, right? That's where I'm going to explain. So what we've done is we've gone out and vetted probably, I'm going to say roughly 100 operators. When I say operators, deal makers, people that are actively looking to purchase into real estate investments, right? Okay. And we chose 3 of them. We chose 3 of them based on their risk profile, their current asset portfolio, their experience, and how all of that looks from the outside with some information from the inside on them. Okay, so we went through probably 100 of these guys and ladies, and we've chose 3. And what we did was, or what I did, got them on the phone, and I said, okay, now if I can get, so this is more for the $50,000 or $100,000 investor that says, hey, I want to invest 50 into a fund. So what I did was I called them up, and these guys have Class A and Class B shares, right? So Class B share gets you a lower preferred return and a lower split. Class A share, but it's a lower minimum investment. Class A share is a higher minimum investment, but it gives you a higher percentage return, a higher pref, and a higher split. So for instance, the Class B share is a $50,000 minimum investment, right? Class A share is $1 million minimum investment, right? The more capital you bring, the less people that the operator has to appease and have relationships with, the cheaper, the more he's able to give you, right? So what we do is we've taken on the role of the investor relations. We take 20 people that have $50,000, right? And we crowd them up. We take their $50,000 and we go to these bigger guys and we say, okay, hey, we've got $1 million to invest. Okay. And we've made it where you can get a better return going that route with us getting a little share in the middle. Then the investors get a better return going that route than they would if they just individually bought in. Okay. So when we, and again, the value comes in the fact that we're purely diversification. We're not for the guy that wants the high risk, high return. Now, some of that stuff is going to be higher risk, higher return, but it's also going to be diversified across a mobile home park in Valdosta, Georgia, that's been stable for 100 years. So there's going to be bigger returns in some areas, but it's going to be more diversified. It's diversified across operators, the 3 operators I spoke of. It's diversified across geography, and it's diversified across asset class.
Yeah.
So when we start looking at having investors come in, again, we want the folks that are not necessarily fully risk averse, like, oh, I don't, I can't lose a dime, because we're not a bond company, or we're not we're not in the bond business, because that's where you virtually don't lose. But we are in the business of owning portions of self-storage facilities, mobile home parks, and multifamily apartment complexes.
Perfect. Okay.
So,
well, that's probably one of the best explanations I've heard anybody make. So I appreciate that. And I got a feeling you're going to probably get a lot of attention out of this too. So, I mean, there's just a lot of, it's a crazy world out there right now, and a crazy economy, crazy market. But the fact remains is there's also a lot of investable dollars available. Like you mentioned 401ks. I mean, there's people with, whole life policies, universal life, index universal life, all those cash values. And that's not even scratching the main bulk of the funds.
Oh yeah, no, there's a ton out there. And here's the thing, people walking around right now, and of course, by the time this podcast airs, things could be completely different. Mm-hmm. But this is the way I see it, and this is the way I explain it on my podcast. My listeners are probably sick of me talking about it, but I'm gonna explain it on here. So back in 2006, there was never going to be another bad day. Everybody was high on life. Everything was great. Prices were up. Life was just stellar, right? And then all of a sudden, we all know what happened 07, 08, 09. Okay. Every day was bad. Grass in probably you had 100 houses, 80 of them had grass this high, 10 of them were renter tenants, and 10 of them were homeowners, and the others were vacant. Okay. Everywhere across the whole country. It was the worst real estate financial crisis of, I guess, my lifetime. All right. Now, going forward, now we're in 2022, and everybody's saying, oh, everything's so high. I just don't want to lose. I don't want to lose. But let me ask you a question. Is there a single asset that you can think of right now, Gary, that you would not buy most likely without even looking at it, for the price that it was in 2006?
Oh my gosh, that's like a no-brainer. I mean,
and it was high. What I'm getting at is you're sitting there in 06, and it's the highest it's ever been. There's never going to be another bad day, which is the same way we are now. So, do you look back 16 years from now in 2038, and say, at what point do you say, hey, let's get in this game and go?
Right.
Because, you might have there's without a doubt going to be a little bit of a downside here. There has to be. But the fact remains that in 16 years from now, you either look back and say, yeah, here we go. There's a reason they give 20-year mortgages. You get you pay that stuff off.
Yeah.
And you're building equity the whole time.
Yeah.
So people have to get through this short-term, the short-term losses are going to be compounded by the long-term gains.
Yeah.
So
it's interesting. We have a saying on our team, which is, because we hear people all the time, consumers say, well, I'm going to wait and buy. And our philosophy is don't wait and buy
and wait.
Yeah. Yep. And we actually did a study, and I'm just going to take a second to explain this. So it involves three cycles, 3 complete business cycles, recession followed by upturn, the whole 9 yards. So if you had bought at the top of, say, a business cycle, whatever, two business cycles ago, then the market goes down, it goes back up again, right? And goes back down, it goes back up. If you'd have bought at the top of, say, cycle A, and then you get through another complete cycle and then sold at the bottom of the next cycle, right? Which is 2 cycles away.
Yeah.
You would have made a ton of money. It's
at the bottom. You bought at the top and you sold at the bottom. I mean, it's still, and the thing is, and resources are limited. And if people don't believe that the price is directly derived from the limited availability of stuff, do nothing but look at Bitcoin. Okay. Bitcoin didn't do anything but tell you it was limited, and it went, right. So what I'm saying is the population is growing every day, every year. It's never gone down. And so we're still dealing with the same resources that we've always had. It's just being converted into different things. Mm-hmm. And so whether, like I said, lumber's being converted from trees to houses, right? But you still have the same amount of stuff. That's the biggie to me. It's just like farmland prices. We're feeding a bigger population every day with the same amount of tillable farm ground. Mm-hmm. So farm ground was Bitcoin before Bitcoin was fun, right? Mm-hmm. So anyway, that's my thoughts.
Well, I'll tell you what, we're probably well past the suggested half hour, but that's okay because it's been a really good podcast. And so what I want to do is I'll probably have it back again, Casey, because I know we you and I have actually a lot in common. Some things you mentioned here we didn't even talked about before that we could definitely talk about in another one. But also I'll follow up with you afterwards, but I teach a class every Monday night. I want to have you do that. And for everybody listening, you just got a real good education here in a short period of time. And if you could leave a good review for Casey Brown's podcast interview here, just whatever channel you're listening to, when you're done, if you could please leave that review. It's the currency of podcast. You don't have to pay for it. We do it because it's part of our business model, and the community of podcasters. It's a great community, and we rely on you, the consumers, to vote with your reviews. So we certainly appreciate it. And, the case, anything? How can a website, chapter in a book? How can people get a hold of you, man?
The easiest way, of course, the first thing I want to do, and if you don't mind, is you just mentioned it, our podcast. We as podcasters work really hard on this stuff, and the hours involved is far greater than the hours that the user receives. And so, if you don't mind to go check out my podcast, it's Cashflow Pro. And you can find our website at www.cashflow.pro. You can also, if somebody wanted to directly reach out to me, my email gets cluttered at times, but I have an assistant that goes through them if I get too far backlogged, and it's Casey, that's CASEY at 3000capital.com. So okay. Gary, thank you so much for having me.
You're welcome. That's Casey at 3000capital.com.
Yep, that's it.
Okay, awesome. Well, you're very welcome, Casey, and thank you also all for you, the listener, for taking your time to do this. I'm pretty sure you got a lot out of this one. And if you, by the way, while you're out there, remember to go to globalinvestoragent.com. Check it out, particularly if you're a real estate agent. Just my philosophy is don't wait and see what the market's going to do. We know what's going to do. We can't tell you when. We're kind of sure about it this time around, but we were last time too. The point is be prepared. Be prepared. Why would you ever wait to figure this stuff out? Just do it now. And plus you can use it for yourself to build your own wealth and income. This is for you agents out there. For all the investors, there's plenty of agents we train all half the country to help you participate in this business. So in any case, we'll see you on the next Massive Passive Cash Flow podcast. In the meantime, take care of yourselves, and God bless you and your families.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.